On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. There's one particular topic that I'm still getting a ton of questions on, both online and in person when I'm out at speaking events or functions, and that is the gold price. It's a really hot topic of conversation, which is no surprise because it's up almost 40% so far this year, and it's been hitting fresh record highs. It's ahead of Bitcoin in 2025. Bitcoin's up about 23%. It's even ahead of Nvidia, which is up about 32% so far this year. And gold has actually doubled in value in these last 3 years. It's up 100%, and that means it's outpaced even the mighty S&P 500 index in the US, which is no small feat because the US market itself has posted a pretty stunning 71% gain over that 3-year period. So let's talk about gold and let's discuss some of the pros and cons that people need to be considering if they're thinking about investing in it or adding it to their portfolio. For centuries, gold has been considered a store of wealth, and it's held its own through economic cycles, geopolitical stresses, and other upheavals. It often attracts attention during periods of uncertainty when investors are looking for a hedge against traditional assets. Unlike paper currencies or fiat currencies, which are government issued and not backed by anything, gold is a tangible asset that isn't tied to one economy or government. Policymakers don't control its supply, nor can they print more of it or erode its value. And that's why it often shines during periods of higher inflation, such as the 1970s. Back then, shares, bonds, or houses couldn't keep up with rampant price increases, so investors went backwards in inflation-adjusted terms, and gold, like the broader commodities space, and I think farmland was one of the other exceptions, gold was one of the few things that performed well, and prices surged 14-fold over that decade, the 1970s. Lower interest rates are also supportive for gold, especially the real interest rate, which is the interest rate less the inflation rate. And that's because unlike shares, bonds, or real estate, gold doesn't offer investors any income. So when interest rates are high, there's a bigger opportunity cost to holding a non-yielding asset like gold. But when interest rates are low or falling, investors don't forego as much, which makes it more appealing, or less unappealing, you might say. Weaker currencies can also have a positive impact on the gold price, particularly the US dollar, which is the benchmark currency for pricing gold. Those last 2 points might partly explain strong performance lately. Interest rate cuts are back on the agenda in the US, while the greenback has weakened from the 20-year high that it reached in late 2022. Central bank buying has also been very strong this year, and for the first time since 1996, gold represents a bigger share of central bank reserves than US Treasury bonds. We've also seen very strong inflows into ETFs, exchange-traded funds. ETFs backed by gold saw inflows of more than US $5 billion in August, and this year has been the strongest on record outside of 2020. Obviously, during COVID, during 2020, you saw very strong inflows and interest in gold, and this year has been the second strongest year of all time after 2020. Looking back over the past 30 years, gold has delivered an annual return of 8% in New Zealand dollar terms. Now that's ahead of domestic fixed income at 5.3% and house prices at 6% per annum over that 30-year period. However, it's behind New Zealand shares, which have delivered 8.5%, and US shares in New Zealand dollars, which have delivered almost 11% per annum over that period. Gold has also been much more volatile than those traditional asset classes, and negative returns have come much more frequently. Those last 2 points are really important if you're considering investing in gold. However, if you take a typical 60-40 portfolio, let's say 60% is in shares, 40% is in fixed income, and if you add a small allocation to gold, let's say 5%, the results get really interesting. The return over that 30-year period increases marginally relative to the 60-40 portfolio without gold, and at the same time, volatility actually falls and the worst 12-month period improves. It becomes not quite as bad. And that's because gold tends to move in the opposite direction to other asset classes, which makes it a really useful diversifier. That's not always the case, but it often is, particularly during rough periods. The 3 worst years for a typical portfolio in recent decades have been 2022, 2008, and 2002. All of which came in the wake of US recessions. Now, your typical portfolio would have fallen about 10% in each of those calendar years, give or take. In contrast, gold in New Zealand dollar terms went sideways in 2002, rose 40% in 2008, and was up 7% in 2022. If you're considering an investment in gold, my first suggestion would be to get some advice. My second is to think of it as a component of a portfolio rather than as a standalone investment. Gold doesn't provide any income and it isn't without risk, so certainly don't go overboard. Some of the recent tailwinds could quickly turn into headwinds. The Federal Reserve in the US might choose to ease policy a little more slowly than markets are hoping. Geopolitical tensions could ease, which would take the shine off gold, or some of that central bank buying that has helped drive up the price could slow. After such a stellar run, it's also possible that all of the good news is simply already in the price. Having said that, a small allocation can make sense, providing additional diversification and reducing portfolio volatility without any negative impact on your long-term returns. I think of gold as part of the alternative assets part of my portfolio, and I liken it to an insurance policy rather than an investment. I'm happy to own a little bit, whilst also hoping that it doesn't perform very well, as that usually means that everything else I own isn't. Hopefully that's useful. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.